In today's video, we are going to start consolidation. Under consolidation, we have total 8 chapters. First one is conceptual principle of group accounting. Second is important consolidation calculation. Third is goodwill. Fourth is changes in shareholding. Fifth is associate and joint agreement. Sixth is foreign currency transaction. Seventh is consolidated cash flow. And last 8 is consolidated P&L and balance sheet. Also, of foreign subsidiaries. So this one P&L and balance sheet of subsidiaries and including P&L and balance sheet of foreign subsidiaries. Now, so we are going to start that first today with conceptual principle of group accounting. Objective to describe that provision of IFRS 10 consolidated financial statement to indicate disclosure requirement of IFRS 12 disclosure of interest in other entities and explain the provision of IAS 27 separate financial statement. So the objective they are saying that the provision IFRS 10 consolidated financial statement to indicate disclosure requirement of IFRS 12 disclosure of interest in other entities. So we need to understand what is disclosure of interest in other entities and explain the provision of IAS 27 separate financial statement. So what are the provision of separate financial statement IAS 27? So the introduction, business combination and IFRS accounting standard, IAS 27 separate financial statement and consolidated financial statement. So we can understand this business combination, exclusion, and IFRS 10. So identify a business, definition of a business, and control. So these are very important key elements. Identifying a business, so whether that is what kind of business that is, and definition of business, what is the definition of that business. So under identifying a business, we need to understand that whether that is a business or not. Because sometimes like we just acquired IAS 16 asset, but we understand that that is a full-fledged business. So there is a requirement, so we need to check it. Now that exclusion, individual subsidiaries, preparation of group accounting and investment entities. So individual subsidiaries, what is individual subsidiaries and preparation of group accounting and investment entities. IFRS 10 consolidation procedure, reporting date, accounting policy, date of acquisition. So all this we need to disclose is IFRS 12 disclosure of interest in other entities and IFRS 19 subsidiaries without public accountability disclosures. So these two we need to disclose. Now IAS 27 separate financial statement apply when preparing the financial statement of the parent. So it will apply when we are preparing the financial statement of parent individual, not here consolidated. Only single parent financial statement. Now, IFRS 3 business combination is applied to determine whether business combination has taken place and it provides the accounting requirement for the acquisition. So same things I said that identifying a business, definition of business combination and control. So this we need to understand under IFRS 3 business combination. Now, IFRS 10 consolidated financial statement is applied with IFRS 3 to determine whether a business combination has taken place and it provides the accounting requirement for the period after the acquisition when consolidated financial statements are prepared for the subsequent reporting date. Means that first we are going to apply IFRS 10 with IFRS 3 to determine whether a business combination has taken place or not. After that, it also provides that accounting requirement once it is done. Now, IFRS 12 disclosure of interest in other entities prescribe the disclosure requirement in respect of all subsidiaries, joint agreement, and associates. So here it is all about disclosures. In a separate financial statement of parent, an investment in a subsidiary or associate or a joint venture is accounted for these three methods. First is cost method, second one is equity method, third one is IFRS 9 financial instrument. Now we are going to see all three methods. First one is a cost method. Under the cost method, the investment is recorded at a purchase price. The carrying amount does not change. Dividend received are recognized as income in profit and loss. Example, parent buys 80% of subsidiary for $500,000. Initial recognition we have investment in subsidiary DR to cash. If subsidiary later pays dividend 40,000, cash DR 40,000 to dividend income. Carrying value of investment remained 500,000. So this 40,000 will go in profit and loss statement, not in balance sheet. Now, under the equity method, the investment is adjusted for the investor shares of profit or loss of the investing. The method is required is the consolidated accounting under IAS 28, investment in associate and joint venture. But IAS 27 also allow it in separate financial statement. So this we use it under IAS 28, investment in associate and joint venture, especially equity method. But IAS 27 also allow in separate financial statement to record under equity method. Parent buys 30% of associate for 200,000. Associate in earns profit 100,000. So parent share of profit is 100 multiplied by 30, that is 30,000. Now we are going to do journal entries. So first at initial means we have already recorded that investment in the financial statement. Now we are going to do journal entries of profit share. So once associate will earn the profit of 100,000. So what we are going to do, we are going to do the general entry investment in associate 30,000 to share of profit 30,000. So this is the general entry we need to do when associate earns profit. At this time, it is not distributed and not have not done anything like the dividend distribution or any plan, just earn the profit. So we need to do the general entry. Once if dividend received, if now that associate is saying that we will distribute some amount as a dividend to our stakeholders. So under that scenario, we are going to do the general entry cash DR because we receive dividend to investment in associate. So we receive the dividend of 10,000. So cash DR 10,000, investment in associate. So new investment value, that is carrying value of our investment in balance sheet, now will decrease by 10,000. Here we have 200,000 investment value in balance sheet. It increased by 30,000 once associate earns the profit. Now associate distributed the dividend, so it is decreased by 10,000 to 30,000 minus 10,000. So now current carrying value will be 220,000. Now IFRS 9 method. Investment is treated as a financial asset under IFRS 9 financial instrument. It is measured at fair value through profit or loss, or fair value through OCI. Example, parent buy investment for 400,000. At year end, fair value is 450,000. So increase in value by 50,000. So if it is fair value method, if it is fair value through profit and loss, then investment in subsidiary 50,000 to gain in profit or loss 50,000. If it is fair value through OCI, investment in subsidiary 50,000 to gain OCI 50,000. So new carrying value will be 450,000. Now, when investment become classified as a held for sale, if it was carried at cost or using equity method. So IFRS 5 non-current asset held for sale and discontinued operation is applied. So if investment become classified as a held for sale, if it was carried using equity method, so IFRS 5 will apply. If it was carried at fair value method, then IFRS 9 will apply. Now, in the separate financial statement, the investment in unconsolidated subsidiary, income from an unconsolidated subsidiary is classified in the investment category IFRS 18. So in a new format of P&L, that is IFRS 18. So we have three categories of same as it is cash flow. We have operating category, we have investing category, and we have financing category. So we need to do that. It will be applicable on 1st of Jan 2027. Now the definition of business. Input, any economic resource. We have 3 points: input, process, and output. We need to understand it before finding whether that is a business or not. Okay. So any economic resource that can be used to create output. So any economic resource such as plant and equipment that is used to create output, it's called input. So intangible asset, intellectual property, and right to access necessary material or employee, these are our inputs. So we use this as an input. Okay. Now the process is any system, a standard, protocol, convention or rule that together with input has the ability to create to the creation of output. So any system, standard, protocol, convention or rule that together work with input has ability to create the output. So it has the together with input and it has the ability to create outputs that call process. Process like example operational process or intellectual capacity of workforce. Now the output may be the provision of goods or service to customer, generation of investment income or other operating income. So the output is final result. What we have, we apply input and process return. The output is our final result. Maybe the provision of goods or service to the customer. It can be anything, generation of investment income or other operating income. So the concentration test. So we need to check that if it is met. Wait, first we need to complete this concentration test. So concentration test is optional test. Concentration test is used to assess whether acquired set of assets is not a business. So this test we use to check whether acquired set of asset is not a business. Okay, we check whether it is not a business. Okay, not for whether it is a business, whether it is not a business. Okay, if concentration test is not met, then we go and check the definition of a business. Concentration test is used to access whether acquired set of asset is not a business. The acquired set of asset are not a business if substantially all of the fair value of total asset is concentrated as a single identifiable asset. Here, all of the fair value of total asset is concentrated as a single identifiable asset. So we can identify it that is single or group of similar identifiable asset, both. So if substantially all of the fair value of total asset is concentrated as a single identifiable asset or group of similar identifiable asset. So under both scenario, it is not a business. If concentration test is not met or not applied, then we need to go for input, process, output, business combination method. Now the control. What is control? Control exists when the investor is exposed or has right to variable return from its involvement with the investee and has the ability to affect those return through its power over the investee. So exists when the investor exposed. Exposed means here investor is going to get the profit or also they will suffer with loss. So exposed means that, not fixed kind of, or has a right to or has a right to variable return from its involvement with the investee, has ability to affect those returns through its power held over the investee. So first that investor is exposed to the risks and also has the power to affect those returns. There are three method power there are 3 points: power over the investee, exposed right to variable return, and ability to affect those return through power held. So simple, we have power over the investee means we got 50% or 51%. So we got the power because we are a parent now. So this is exposed right to variable return. Once we got the power, so we have right to we are exposed to the variable return, means if the company will earn the profit, we are going to earn the proportion of that profit. If company will suffer the loss, we are going to suffer the loss. And ability to affect those return through the power head means that we are having power now, so we can influence that return. For example, if we took the decision something else, so we will get something else. For example, we took the decision to invest in new plant and machinery, so that kind of things it is here. So once we will invest in new plant and machinery, new factory, so our return will increase. In many straightforward situation, power is gained by holding more than 50% of voting right in the investee. So sometime power is also get if we don't have 50% of voting right. Okay, but that is a different scenario. The assessment of voting rights should be take into the account any potential voting rights that the investor hold in investee, example share option or convertible instrument. In order to contribute to control, these must be exercised or convert at the current time. It is not the case, they are ignored. Now, exemption from preparing group accounts. A parent need not present consolidated financial statement if the following conditions are met. All, sorry, all of the following conditions are met. If any single miss, then we need to prepare. It is wholly or partially on subsidiary with NCI's consent. So wholly or partially own subsidiary means that we fully own that or partially own that, but NCI give the consent. If the parent debt or equity instrument are not traded on the public market. So if parent is not a listed company, third one is the parent is not in the process of issuing securities in public market. Again, same thing. Parent does not have any kind of securities, like issue securities in public market. Now, the fourth one is that ultimate or intermediate parent present consolidated financial statement in accordance with IFRS accounting standard. So, ultimate or intermediate parent means, for example, there is one subsidiary, and you can understand this. Now, company A owns 50% of company B, and company B owns 50% of company C. So here for the company C, ultimate parent is company A and intermediate parent is company B. So if all four criteria are met, then parent not need to present the consolidated financial statement. So here parent will be company B. Okay. Investment entity and entity which obtain fund from one or more investor for the purpose of providing those investor with the investment management service. Commits to those investors that its business purpose is to invest funds solely for return from capital appreciation or investment income or both. So the investment entities, what are investment entities? So first investment entity is an entity which obtain funds from one more investor. So they obtain fund from one or more investors for the purpose of providing those investor with the investment management service. So they provide that investor investment management services. Now, commits to those investors that business purpose is to invest funds solely for return from capital appreciation or investment income or both. So the commitment is that invest funds solely for the return from the capital appreciation or investment income or both. Now, the measure and evaluate the performance of substantially all of the investment on a fair value basis. So they will measure and evaluate the performance of substantially all of the investment on fair value basis. An investment entity as defined above must not consolidate its subsidiary or apply IFRS 3 when obtain control of another entity. So an investment entity as this one not consolidate its subsidiaries or apply. So they will not consolidate their subsidiary or apply IFRS 3 business combination. It must instead apply IFRS 9. So they will apply IFRS 9 financial instrument and measure those instruments at fair value through profit and loss. So they will select fair value through profit and loss under IFRS 9. If investment entity has a subsidiary whose main activity is providing service to the investment entity, that is subsidiary is consolidated as normal. If an investment entity has a subsidiary whose main activity is providing service to investment entity, that subsidiary is consolidated as normal. So that subsidiary will consolidate it as normal. This exemption does not apply to parent of an investment entity unless the parent too is an investment entity. Such parent is still required to consolidate all of subsidiaries, including investment entity subsidiary. For example, they are saying that the exemption does not apply to a parent of an investment entity unless the parent is an investment entity. So parent itself is an investment entity, then it will not apply. Okay. Otherwise, it will apply to the parent. Such parent is still required to consolidate all subsidiaries, including investment entity subsidiaries. Now, individual subsidiary means the subsidiary's financial statement prepared separately, as if it were a standalone entity. So instead of looking the group account, we look at only the subsidiaries account. Means investors individual subsidiary financial statement prepared separately first, and if it were a standalone entity. Instead of looking group account, we look the subsidiaries account. Now, consolidation procedure. After IFRS 3 is applied to the accounting for acquisition of business, IFRS 10 is applied in the preparation of consolidated financial statement. So IFRS 3 is applied for acquisition of a business, and IFRS 10 is applied for preparation of consolidated financial statement. The process of consolidation involves combining the asset, liabilities, income, and expense of the parent and its subsidiaries on a line by line basis. So on a line by line basis, this is very important line. Eliminating the carrying amount of the subsidiary in the parent separate financial statement against the subsidiary's equity. So we need to eliminate the carrying amount of the subsidiary in the parent separate financial statement against the subsidiary's equity. Once we will prepare the balance sheet, we will see that how it shows. Eliminating in full intra-group balance and transaction and resulting unrealized profit, and recognizing an NCI in respect of the part of the subsidiary that is not owned by the parent. So we also need to calculate NCI and recognize it. IFRS 10 provide further guidance in respect of certain aspects of consolidation. Now, reporting date. If reporting date differ, the subsidiary should prepare for consolidation purpose financial statement at the same date as the parent. So if reporting dates differ, the subsidiary should prepare consolidation purpose financial statement at the same date as the parent. So subsidiary will prepare the consolidation financial statement same days as parent prepare their financial statement. However, if the impracticable, the subsidiary's most recent financial statement may be used if the difference is not greater than 3 months. If difference is not greater than 3 months and adjustments are made for the effect of significant transaction or other event that occur between those dates and the dates of the parent financial statement. So if the difference is not greater than 3 months and the adjustments are made the effect of significant transaction or other event that occur between those dates and the dates of parent financial statement. So they are saying if it is impracticable. So like for example, it cannot be possible. Parent and subsidiary means subsidiary will prepare their financial statement on same date as parent. So the difference is so the most recent financial statements will be used of the subsidiary. So we will take the subsidiary's most recent financial statement, but the difference is not greater than 3 months, and adjustment are made for those effects significant transaction, not a significant transaction or other event that occur between those date and the date of the parent financial statement. For example, this 3 months period, if there is any significant transaction, we need to consider it in the consolidation. Now, accounting policies. If a group member use different accounting policy, example, foreign subsidiary following local GAAP, appropriate adjustment must be made the consolidation state. So we need to adjust it. For example, parent is belong to UK and subsidiary is belong to US. So in US, there is US GAAP. And in UK, they follow IFRS accounting standard. So we need to adjust it, that US GAAP financial statement as per the IFRS. Now, this is very important point, that is date of acquisition or disposal. The result of operations of a subsidiary are included in the consolidated financial statement as a form from the date parent gain the control. When parent gain the control, we are going to say that date is acquisition date, the date when parent gain the control. So everything will be measured from that date of subsidiary when the 50% threshold has been met. So parent gain the control of the subsidiary and when 50% threshold has been met. Any previous shareholding will be remeasured to fair value of the acquisition date. So any previous shareholding we have, that will be remeasured on the acquisition date, means gain on the control date. The date of acquisition and date of disposal are based on the when control passes, not necessarily that legal date of acquisition or date of disposal. So once we gain the control, that will be acquisition date. Once we lose the control, so that will be disposal date. Thank you for this video. In next video we will study chapter 2.